First and foremost, thank you so much, everyone, for joining us tonight for our training session. We're going to be going over hot topics in the CPA world as it relates to HOAs. Quick introduction of myself. My name is Jeff Obrol. I'm the Training and Development Manager here at Cadden Community Management. I've been at Cadden for over 8 years and in the HOA world for over 20 years. So for the first time I'm meeting you tonight, thank you so much for joining us, and keep an eye out for the email updates on future training sessions. Tonight we're going to be joined by Paul Hansen from Butler Hansen. Let me give you a quick little background of Paul, and I'm sure he'll give you a little bit more as well. Paul began his accounting career here in 1999 and has devoted over 20 years of serving the community association industry. He leads a team of professionals who provide financial reporting, tax, and advisory services to hundreds of homeowners associations, from small neighborhoods to master plan communities throughout Arizona. Recognized as a trusted expert in the HOA accounting and financial management world, he is passionate about supporting the success of board members and community managers. He regularly conducts educational seminars and training sessions across the state, helping communities strengthen their financial understanding and governance. A graduate of Arizona State University, Paul enjoys traveling with his wife and spending time with his 3 children and taking part in outdoor activities like diving, camping, and fishing. So real quick, before I turn the session over to Paul completely, as you probably noticed, everybody is on mute tonight, but you do have access to the chat. So please, if you have questions or if you would like to participate, please use the chat. I'll keep an eye on that through the evening. And if we don't cover your question tonight, or if you think of something later, please feel free to email me and we'll get back to you. All right, Paul, it's all yours.
All right, Jeff, I appreciate it. Appreciate the opportunity to spend some time with those of you that are joining the meeting tonight. And then as the link goes out to hopefully other boards and other communities that Cadden manages, hopefully the topics tonight will be on point, something that will add value to you as you try and manage the affairs of your communities. So as Jeff mentioned, my name is Paul Hansen with Butler Hansen. I'm a partner with the firm. We provide services for about 2,000 communities in about 15 states, so quite a number of clients. And tonight I was invited to talk about some hot topics as it relates to community association taxation, budgeting, inflation trends, auditing, that sort of thing. It's probably not the most exciting topic. However, I'm more than happy to share information. It seems like it's the attorneys that always get the big audiences. So anyway. As we consider what happened today with the Fed, we know that the Fed reduced interest rates about 25 basis points. I don't know if anybody saw the news today. The Fed basically indicated that as far as lowering rates in December is concerned, it may not happen. So how does that affect your association? Well, that's what we want to talk about tonight. And so with that said, I want to talk just a little bit about inflation trends, because certainly the last few years we've seen a tremendous amount of inflation that's really negatively affected community associations. Now, forgive me, this chart that you're looking at is not from the Tucson area, but it certainly, I guess you'd say, demonstrate what's been going on in the Arizona region from about February of 2021 to February of 2024. And quite frankly, from February of 2024 to the present, the fall of 2025, things haven't changed too much. What I wanted to quickly demonstrate is, as we approach budget season, is after COVID hit, of course, in March of 2021, about a year later, in February of 2021, we started to see a spike in inflation. And inflation actually continued to creep up until about July and August of 2022, when in the Phoenix, Scottsdale, Mesa metro area, we had inflation hit 13%. That's an absolutely astounding number, 13%. And so our inflation, actually, the highest inflation in the country, was not in areas that you would anticipate or think of, maybe areas like New York, Los Angeles, San Francisco. But the highest rate of inflation actually was here in the wonderful state of Arizona. And how that affects homeowners associations is as we saw COVID hit, we saw a significant reluctance of board of directors to raise assessments during that time period because COVID was happening. There was a lot of uncertainty. People didn't know what was going to happen. And so boards as a general whole did not raise assessments. And so we had this situation where for 2021, 2022, there weren't a lot of assessments that were raised. But unfortunately, during that time, we saw our operating costs increase tremendously. And clearly inflation has subsided substantially from, the July of 2022. It slowly crept down. And actually, if we were to draw a line from right here, February 2024 to October of 2025, we've actually bumped back up really right here to the 3% mark. Okay. And we know that the Fed, that their target for inflation, their job is, as they've said for many, many decades, is to try and keep inflation at about 2%. Unfortunately, it seems like the last year, the Fed has seemed to have changed their operating strategy, meaning it seems like they appear to be accepting that inflation is here to stay. Inflation is sticky. And in fact, inflation, a more quote unquote realistic target moving forward, might be 3%. You need to know that as boards. And you need to know that because as you set your budgets for 2026, what should your minimum assessment increase be? Well, theoretically, just to keep up with inflation, you need to set your assessment increase for 2026 at least 3%. That's the bare bones. Because if we don't set our assessment increase at 3%, how are we going to pay for our goods and services that we receive going into 2026? Now, as I mentioned, a lot of course, this shows the decline in inflation, in the consumer price index, actually. But as we look at just different charts that I thought you might find interesting, this chart's actually interesting. I'll share this with you very, very quickly. This was a chart I put together to help members of your communities, those that are going to be viewing this training, and those on the boards understand exactly when we consider inflation, the effect that it has on your purchasing power. Here you'll see that, as an example, in August of 2019, if you paid $100 for something, you can see that in January of 2024, that same item that you paid $100 for 5 years earlier is now costing you $125, $126. And so when you have that kind of inflation, core inflation, it really, really affects negatively the purchasing power of associations. Purchasing power obviously goes down, expenses go up. So what do we do to make the difference? And so that's kind of what we're facing as a country right now. As I mentioned, the latest national CPI inflation number, this shows February of 2025. It actually could read September of 2025 because we are basically stuck at 3%. As we consider consumer credit card debt, again, to try and put this in perspective, consumer credit card debt is over $1 trillion now. Home delinquencies, auto delinquencies are going up. Obviously, cost of a home ownership is increasing. Mortgages, obviously, those rates have been pretty sticky. The point that I'm trying to make is that as we consider inflation, it's sticky. It is sticky. The inflationary pressures are remaining in the economy. And so be very, very careful. I caution you as you go into the 2026 budgeting cycle, you're going to need to budget for at least inflation of at least 3%. But as I mentioned, quite a few communities, unfortunately, didn't raise assessments at all in 21 and 22. And so we saw inflation just in 1 year that was 13%. But if you add the 13% with 7 or 8% in 2023, with 3 or 4% in 2024, obviously our operating costs go up tremendously as you start to add in the inflation year over year. Now, what's interesting is that as it relates to reserves, our reserve costs have increased a lot more. Now, the inflation that I've been mentioning so far is basically just our inflation relating to our operating costs as an association. If we consider costs as it relates to reserves, those costs have actually more than doubled. Case in point, what you're looking at right here is my wonderful community in Gilbert, Arizona. And this, what you're looking at is a Google map of the streets that my community is responsible for maintaining. Now, ever since I moved into the community in 2009, we have had a target of $400,000 for replacing our streets. Reserve study companies have told us, I'm on the board for many, many years, that it would cost about $400,000 when we need to actually tear out and replace our streets in 2030. We've been budgeting for that for over a decade. We just barely had well, not barely, it was about 2 years ago now. We had a reserve study update conducted. And and by the way, this is a community of 84 homes. And what that update demonstrated is that our replacement costs now that we thought were going to be $400,000 are now $800,000. That was what the latest reserve study update told us, is that now to replace the streets in my community, it's going to cost $800,000. We don't have the money. And so as a community, we are going to have to do a maximum assessment increase, which is 10% in my community, every single year until 2030, so that we have the funds to actually make those repairs. The point I'm trying to demonstrate here is that as we look at communities all over the state of Arizona, this is what we're seeing. We're seeing communities that are struggling operationally. They don't have enough money to pay their bills because they didn't raise assessments like they should have between 2001 and 21 and 2023, 24, because the boards didn't want to be the bad guy, right? Nobody wanted to see a 20 or 30% in assessment increase to keep up with inflation. And so we see boards, communities that are suffering operationally. They're struggling to pay their bills for landscaping, for utilities, for management costs. And we see communities that are deferring major maintenance projects because they don't have enough money in reserves. And so what we're seeing is communities that have gone from being 70% funded or 60% funded to being 20 or 30% funded because we've seen those costs related to major repairs and replacements increase so much. So kind of a precarious situation as we emerge from COVID and we emerge from really the unprecedented inflation that we've had for the past few years. And so that's one thing I wanted to share with you tonight. Again, my firm provides services for over 2,000 communities in 15 states. I see a lot. Over the course of my career in 25 years, I've seen hundreds of thousands of financial statements, maybe millions. I've seen a lot. And so as an outside third party, I do a little bit of work for Cadden managed communities, to be honest, not a lot. So my point being, I don't have a horse in this race. Cadden asked me to present some thoughts to the boards that they manage tonight so that they could, quite frankly, share some information from an accounting and tax perspective. What I'm seeing, again, kind of scares me. I have a lot of associations that are in a very, very difficult position from a financial standpoint. So let's change gears a little bit. I wanted to just provide a little bit of perspective for the thoughts that I'm going to share about budgeting. Because as we consider budgeting, what you're looking at is the most common budget mistakes that I've seen in 25 years. These are the budget mistakes that we see boards make, the most common budget mistakes, actually. And so the number one budget mistake that we're seeing boards make is setting assessments too low. And again, forgive me, I should have changed this from 2025 to 2026. So should assessments increase for 2026? The answer is probably. When we're running at 3% inflation, you're probably going to have to raise assessments going into 2026, okay? Especially if you don't have enough money right now to pay your bills. I would caution you as we go into 2026, the Fed backed off today from lowering rates again in December of this year. They backed off from that. And the market this morning, the stock market was up. When the Fed backed off this afternoon in their meeting and said, "Hey, we're going to lower interest rates 0.25% today, but we may not do it in December," the stock market suddenly retreated tremendously because investors it really built in that there was going to be a rate cut in December. It may not be. Why am I talking about that with you tonight? The Fed believes that inflation is getting a little bit stickier, clearly from their meeting and their comments today. And so they want to proceed with caution. As boards managing your communities, governing your communities, I would admonish you to do the same. Okay. Now, the next common blunder that we see is not budgeting for income taxes. What's interesting, and I'm going to go forward a few slides to demonstrate what I'm going to talk about right now. What's interesting is that when we saw inflation spike, now I'm going to make you dizzy because I'm going to go between slides. But when we saw inflation spike to 13% in July of 2022, costs absolutely went haywire. And in order to try and get those costs down, what did the Fed do? They increased interest rates, right? We increased interest rates to kind of calm the economy down. And because what is inflation? Inflation is we have simply too many dollars sloshing around in the economy that are chasing too few goods and services. And so in order to combat that, the Fed raised interest rates. And we can see right here that as they raised interest rates, that had an incredible effect on the rate of return on CDs. What you're looking at right now is actually a CD history, I guess you'd say, on 3-month CDs from 2007 to 2024. And what you'll note is that in August of 2007, you could go out as a board and you could get a 5.5% rate of return on a CD pretty easily. And then, of course, the Great Recession began in December of 2007 with the housing crisis and the financial debacles. And interest rates just absolutely tanked, right? They just absolutely tanked. They went actually below 1% to 0.25. We went pretty low here. And what's interesting is that between about 2009 to 2017, interest rates remained below 1%. Again, I'm changing gears now. I'm talking about rates of return on CDs and investments. Earnings that associations can have from their money that's accumulated for reserves. And December of 2018, it spiked to 2.7%, and then we went back down for a period of time. We went to almost zero again. And then in 2022, as the Fed raised rates to combat inflation, well, we suddenly saw what? We saw the yield, or the rate of return on investments, go to as high as 5.5%. It's an incredible thing. Boards were happy all over the nation. Suddenly we had a situation where we could go out as boards and we could get rates of return of 5.5% on our CDs. What the boards didn't anticipate and nobody budgeted was that, and the reason that nobody anticipated or budgeted for taxes in connection with the 23, 24, and 25 budget years is nobody had been used to paying income taxes for 15, 20 years because our rates of return on CDs were basically zero. And so the argument was made, well, associations are not for profits. They don't have to pay taxes. Well, part of that's true. Associations are not for profits. They're organized under the not-for-profit statutes of the state of Arizona, but they're not tax exempt. Only tax exempt organizations don't have to pay taxes. And so as homeowners associations, you're not for profits, but that only means that you exist, right? You don't exist to generate a profit. You exist to collect assessments from your members, pay your bills, and not make distributions to the membership. However, if you have other non-assessment related activity, you do need to pay income taxes on that money. And so we saw associations in 2023 and 24 that suddenly they were paying $2,000, $3,000, $4,000, $10,000. I actually had some associations that were paying hundreds of thousands of dollars in income taxes. And in the previous 10 or 15 years, they haven't paid anything. And so if you get nothing else from tonight, If you're an association generating quite a bit of interest income from CDs or other investments, be sure to budget for income taxes. And quite frankly, you should budget about 35% of whatever you're bringing in interest and dividend earnings to taxes. 35%. 30% to the federal government, 5% to the state government. Okay, so that's a really, really common budget mistake right now. Another really common budget mistake is not sufficiently funding the reserve fund. As I mentioned earlier, we had associations that did not want to raise assessments in 2021 after COVID, or 2022, or if they did, it was very modest. Same thing in 2023. And so now we have a situation where inflation's gone through the roof. We're having a hard time paying our operating costs. And yet our costs associated with making major repairs and replacements have more than doubled. And so we have, again, a situation where associations simply are not funding reserves to the extent that they should. Again, I would remind you that industry best practice is to have a reserve study performed about every 3 years, and then to fund your reserve fund in accordance with the recommendations of the reserve study. That is industry best practice. Now I can scare you a little bit. I don't know if I should, but I'll scare you. The most tragic example of not funding reserves is the Surfside condo collapse in Florida a few years ago. The board of directors did not raise assessments as they should, so they couldn't maintain the property as they should. We had a situation where, quite frankly, the pools on top of the roof of that Surfside condo tower was rusting. And as the rust started to deteriorate underneath the pool on the roof, as the pool started to collapse, it was actually the pool that pulled down the whole building as the pool collapsed due to deterioration. The reason I mention that is if you read all the indictments and everything associated with the Surfside collapse, members of the board were charged with, I believe it was murder. If it wasn't murder, it was manslaughter. It was a very, very ugly situation. The board of directors had a fiduciary responsibility to maintain the community. They didn't, right? And as a result, it was an absolute catastrophe over there. Now, do I think any of you are going to have pools that collapse and cause something to the extent of Surfside? Of course not. Hopefully not. However, as a board, it's important to remember you do have that fiduciary responsibility to the association, not to yourself, but to your association and the members of the association to make decisions that are the best for the association moving forward. So again, I would strongly encourage you to have a updated reserve study done if you don't have one, and then to fund it. It is impossible, and I know Jeff would agree with me, it is impossible to actually set an accurate annual assessment. It is a theoretical impossibility. I don't know how many times I'm going to repeat that, but it is a theoretical impossibility to set an accurate annual assessment unless you've had a recent reserve study done. You can't do it. It's literally impossible. You know how much money, obviously, as a board, you know how much money it costs to keep the lights on. That's easy. You know how much your utilities are. You know how much your management fees are. You know how much your general repairs and maintenance are, your tree trimming, your landscaping, management, printing. You know those costs. It's not rocket science. What you don't know is how much money you should be setting aside every year for future major repairs and replacements so that you can repair and replace the common area to maintain your community. And so that's why I'm saying it's a theoretical impossibility to set an assessment if you only have one piece of the equation, the operating piece. You have to know how much money it takes to keep the lights on, and you have to know how much money you should be setting aside every year for future major repairs and replacements. Once you know those two numbers, then you can actually start to budget, right? Now, a couple other items I'll caution you on is as you're budgeting, know your documents. Know your documents, know your documents, know your documents. Obviously, you need to know what your organizational documents are. in community associations, those are typically your articles of incorporation, your bylaws, and your CC&Rs. You have to operate within your documents. You can't raise assessments in excess of what your documents allow. And so for planned unit developments or single family homes, what's state law? I hope everybody that sees this presentation at some point will know that off the top of their head. If you're on the board of directors of a community, you should know that state law in Arizona does not allow you to raise assessments more than 20% for single family homes. That's state law. You should know that if your organizational documents limit you to 5%, you're not going to raise your dues more than 5%, right? Because of state law. If you're a board of directors of a condominium, you should know that state law is silent as it relates to raising assessments. You can raise assessments 1,000% if you want. There's no problem from a state law perspective. You need to be aware of that. If your documents limit you to 5%, you need to be aware of that as well. And so my point being, those are common budget mistakes that we see. Not operating within the confines of maybe state law, maybe not operating within the confines of your organizational documents. Don't make those mistakes. You don't want to be that board, I can promise you that. Other budget mistakes we're seeing is keeping operating working capital that's simply insufficient, right? What does that mean? Well, if you have $10,000 in your operating account and you have $10,000 worth of bills, you don't have enough money in your operating checking account, okay? You don't want to be operating on such a razor thin margin that you have to wait for assessments to come in before you pay your bills. Associations are allowed to and should accumulate enough money in their operating fund so that they can pay their bills in a reasonable period of time without waiting for additional money to come in. We refer to that as operating working capital. All associations, industry best practice is to have 2 or 3 months of operating working capital on hand, meaning if you pay $120,000 every year in operating costs for utilities, landscaping, maintenance, you should have, if you divide that $120,000 by 12, you should have $20,000 to $30,000 in your operating account at any given time so that you can pay your bills. Again, I'm just referring to the operating account. And again, anybody on this session tonight or participating, if you have any questions, please ask them in the chat. I'm more than happy to answer any questions or concerns in real time and not wait till the end. I'd like this to be an interactive course. We don't have hundreds of people on tonight, so we're not going to get all kinds of questions. But those that are participating, I certainly would like to answer any questions that you may have. So again, we've talked a little bit about inflation. I will caution you, inflation is remaining pretty sticky, and I think it will be going into 2026. I'm not an economist, I'm a CPA, but I've been doing this for 25 years. I'm not exactly a spring chicken. And so I would caution you about that going into 2026. As it relates to budgeting, be careful. Don't make some of those common budget mistakes. We talked a little bit about interest rates. Clearly, interest rates are going to go down, right? In fact, they're going down tomorrow. As a firm, we realize a percentage, a rate of return on all of our, of course, deposits. We keep a lot of money on hand. We have 20 employees. It takes a lot of money to run this place. So we keep, I'll just say, a lot of money in the checking account, well into the hundreds, thousands of dollars, if not more, because our payroll is so significant every 2 weeks. My point being, I'm not going to have all that money sitting in a checking account, not earning any money. And so I earn a certain percentage every month, which I like. I always see it when I have thousands of dollars of interest that I've earned. I'm a very, very happy business owner. But I'm very unhappy the day after the Fed meets every time, because I'll get a letter in the mail next week saying, Paul, you're now getting 25 basis points less for anything you have in your checking or savings account. That letter seems to go out from my bank within hours of the Fed making a decision. Whereas if the Fed raises rates, I don't seem to ever hear about that from my banks, if I'm being real. But I have to call my bank and say, hey, I don't know if you're aware, but the Fed raised rates. When are you raising mine? And so as it relates to rates, the reason I have this slide is, clearly our rates of return between the end of 2024 and the end of 2025 have gone down by, 1.5%. So again, adjust your budget accordingly. Obviously manage your investments so that you're getting, hopefully, the best rate of return as you can. My pet peeve as a CPA, I'll tell you right now, I get very, very mad when I see this. I see some management companies that will keep hundreds of thousands and millions of dollars actually in operating accounts of their communities that they manage. Makes me very, very unhappy because if you just look at your basic rates of return on CDs on $100,000 right now, you can earn $3,000 to $4,000 easy on a $100,000 CD. If you have $500,000 in the bank, you can easily be earning $20,000 in interest right now, even with the decrease in rates that occurred today. And so be sure that you're managing your investments so that you're actually getting some rates of return, on the money that you're accumulating in the operating and reserve fund. Next, I want to talk a little bit about taxes. I don't want to put you to death, don't want to bore you. But the next slide you're looking at is just a brief slide. Don't worry, there's one slide on it. I don't want to kill you all, as it relates to homeowners association taxation. I know it can be a very exciting topic. Just keep this in mind. Your community is a nonprofit community. You're not tax exempt. Okay, so the IRS wants to hear from you. The IRS hears from you every year by you sending them a wonderful postcard in the form of a tax return. Now that postcard or tax return is going to take the form, one of three different forms. One, the 1120H, which was actually formed in 1973. Congress made the 1120H available for homeowners associations to file in 1973, the year I was born. It was a good vintage. Because before that time, Jeff, I got an eye roll on that one, didn't I? Before 1973, associations actually had to file the regular corporate long form, the Form 1120, the same form that General Motors files, if you can imagine, that same form. And so Congress and the Internal Revenue Service says, well, geez, these associations, that's kind of tough. They have to fill out the same form as General Motors? Wow, that's tough. So they created the Form 1120H, which made it so that associations would only pay taxes on what's referred to as their non-exempt earnings. Think interest earnings, dividend earnings. Most associations file that today. However, the problem with that form is it has a flat tax rate of 30%. So if you have a high amount of interest or dividend income, you don't want to file that form if you don't have to. Because the Form 1120, which is the same form that General Motors files, the same form that Apple files, the same form that Tesla files, you're now in the big boys and girls club. If you file that form, I have a lot of associations that file that form now because the flat tax rate on that form is currently 21%. So we save 9% on federal and state federal taxes when we file the Form 1120. Third option that your association may have is to actually file a tax return for a tax-exempt organization. Now, of my 2,000 clients, I only have 40 that file this form. It's very rare. Some homeowners associations are deemed to be serving the needs of a community or a population that is so large that they're deemed to be like a town or a city. And as a result, they can receive from the federal government, they can be recognized as a quote unquote tax exempt organization. So they actually don't pay taxes on their interest and dividend income. So I don't want to spend too much time on that because it is rare. However, it's important for you to know that if you're a homeowners association, you will file one of these three forms. Which form you file is dependent on your organizational structure and type. Last point I want to make, again, if you're an association, please budget on paying taxes on any interest and dividend income. If you receive cell tower income, which I have a lot of associations that generate tens of thousands and hundreds of thousands of dollars from cell towers, cell phone carriers will pay the association to have cell towers on their premises. That is taxable. So budget 35% of that at least in taxes. Lastly, if you have a strange or an atypical transaction that happens for the year, call your CPA. If you receive land in connection with a condemnation settlement, we've received a lot of that up in the Phoenix area lately for some of the freeways that have gone in. Land sales, whether voluntary or involuntarily, chances are that's going to be taxable. So contact your CPA to make sure that you budget accordingly. And if we had more people on this call, I'd say, hey, do you have any questions? Because it seems like we always have a lot of questions as it relates to taxes. But not gonna spend a lot of time on this. And now I'm just really moving along because I didn't really want to changing gears. I didn't want to spend too much time on accrual accounting. This just is not the night for that, I don't believe. Well, what I did want to spend maybe a little bit of time on, and then I'll end and we'll see if you have any questions, is, I have a lot of boards that will reach out to me and they'll say, Paul, I don't understand what an audit is. I don't understand what a review is or a compilation. What is it? Please explain that to me. And so I wanted to spend about 5 minutes on that. And so remember in the great state of it, well, I'm going to back up a step further. If you're on the board and you want to keep your association's nose clean from a financial perspective, you have 3 or 4 things you need to do every year. And that's all. 3 or 4 things. 1, create a budget. Send it out to your members. 2, make sure that your management company is filing with the state of Arizona, the Arizona Corporation Commission filing. That has to be done every year. If it's not filed, your corporation will be administratively dissolved, which is not a good thing, because then you theoretically you no longer have your shield as a corporation from a liability perspective. 3rd, get your tax return done. The state of Arizona and Uncle Sam want to hear from you. So again, those are the 3 easy things to keep your nose clean from a financial perspective. Let's create a budget. Let's get the Arizona Corporation Commission annual corporate filing done. Let's get the tax return submitted. And 4th, and finally, Arizona state law requires every association in the state to have an annual audit review or compilation performed every year. It's not voluntary. It's actually involuntary. The state requires it. Why? Well, back in 2002, 2003, when I was starting my career, there was a lot of fraud that was going on with homeowners associations, a lot of fraud. And the state legislature kind of threw down the gauntlet and they said, we're done. We're done. We're done with all the fraud going on. And so now we're going to require all associations to have an annual audit review or compilation performed by a CPA. Okay. And that was done again as a way the state wanted for somebody else to come in and look at your financial statements and to then report to you as a board of directors if those financial statements were a complete and utter body of lies. Okay. And so I refer to it affectionately actually as the CPA Employment Act of 2002. Okay. So you can also call it the CPA Employment Act of 2002. It created a lot of work for CPAs. So what in the world is an audit review or compilation? Well, I could bore you with a lot of technical terms, or I could give you a healthcare example. So I'm going to take 2 minutes and give you a healthcare example. And by the end of it, I think you'll understand the difference between an audit review and compilation. So if Jeff was not on mute, but he's on mute, I'd ask Jeff a few questions with Cadden. I'd say, Jeff, okay, let's ask you a few questions. If you weren't feeling well and you went to the doctor, right, and they call you back to the doctor's office to talk to you, what's the first thing they do when they call you back?
Take your vitals.
But before they do that, they embarrass you.
They embarrass you?
At least they embarrass me, right? They ask me to go back, and then they ask me to step on this little box on the floor.
Yeah. They take your weight. Yep.
Right? They weigh you to shame you, right? To shame you. And so if you're not feeling good, you go to the doctors, and of course, the first thing they do is they weigh you to shame you. And of course, we all do the same thing. We put our purses down, not me, my man bag. I put my keys down and my phone to try and get that half pound off of there. And then they take you back in the room and they take your vitals, right, Jeff?
Yes.
Okay. Now, again, let's say you went to the doctor and you weren't feeling well. The doctor taking your weight, or the nurse, and taking your vitals, does that give you a high comfort level that you're not going to drop dead tomorrow?
No, it does not.
Not really, right? But let's say if you went to the doctor and they took your weight, they took your vitals, but then you're really not feeling well. And so they said, you know what, Jeff, why don't we have you have some blood work done, right? And maybe some other minor diagnostic type of procedures. And let's say you go and you have your blood panels done, additional diagnostic procedures. Do you have a little bit of a higher, we'll say, level of assurance that you're not going to drop dead tomorrow?
Yes.
A little bit, right? You do.
Yes.
But let's say, Jeff, that you have that done and you're still not feeling well. You go back to the doctor. And at this point, you've been to the doctor 2 or 3, 4 times, right? Kind of bugging the doctor. And so the doctor's like, okay, Jeff, you're not feeling well. I think you're fine. I think you're a bit of a hypochondriac. But let's play. You want to play ball? Let's play. What are some additional procedures that a doctor could, diagnostic procedures that a doctor could employ?
Goodness, we could do MRIs, CAT scans, X-rays, all sorts of fun procedures.
Right. But let's say you ticked off the doctor. What are they going to order for sure?
Oh, there are some more invasive procedures they could do.
There are there? So if I was a doctor, I'd say, Jeff, you're getting a colonoscopy. Congratulations. You've just won the lottery, right? And so you have the colonoscopy, maybe an endoscopy, maybe an MRI, CAT scan, a lot of procedures done, right? A lot of workup. And let's say all those tests come back clean, Jeff. Do you have a higher comfort level that you're not going to drop dead tomorrow than the first time when you went in and had your weight taken with your blood pressure?
I would have some more assurance, that's for sure.
You would. So thanks, Jeff, for being my playing with me here. So what I've just described to you is, quite frankly, the different levels of reporting that CPAs provide. Having your weight taken and having your blood pressure taken is a compilation. The procedures are very, very limited, the procedures that a CPA performs. And so your assurance on the financial statements, quite frankly, should be very limited as well. The assurance meaning a CPA is not telling you there's not necessarily a train wreck or that you're not going to drop dead tomorrow. They applied a very limited amount of procedures to a compilation. In a review, a CPA does more extensive procedures. A CPA will make inquiries. A CPA will perform analytical procedures to make sure the numbers appear to be materially correct. And then a CPA will issue a report that states, we're not aware of any material changes that need to be made here for these financial statements to be accurately presented in English. There's nothing here that indicates that, Jeff, you're not going to die tomorrow, right? And in an audit, the CPA issues a formal opinion based upon the endoscopy, based upon the CAT scan and the colonoscopy and everything else, based upon all of the testing that we've performed. A CPA will say, in our opinion, your financial statements are fairly presented. And so are there cost differences between audits, reviews, and compilations? Of course. The more diagnostic procedures that are performed, or the higher level of assurance, the higher the price. Most compilations in Arizona, or most CPA firms, I think, charge about $600. Reviews range anywhere from $1,200 to $2,000, and audits range anywhere from probably $2,000 to $10,000, $20,000. I have some audits that I perform for master plan communities with tens of millions of dollars in their operating budgets that pay $50,000 for their audit fee because it takes months to complete. Your average association will probably pay, if I were to just spitball, probably $3,000 to $4,000 to have an audit performed by a CPA. And so, just to very briefly restate, and then we'll end. Watch yourself as it relates to inflation. Those inflationary pressures remain. I'd really caution you going into budget season 2026. I think your minimum, as a professional that's been in this industry for 26 years, I think your minimum assessment increase has to be 3%. If you don't have any money in your operating account and your reserves are really, really severely underfunded, you may have to raise assessments 5 to 10 to 15%. We have some associations that are so far behind the 8 ball that documents limit them so severely that they actually, there's some associations that we've done cash projections for that it may take them a decade or more to get out of the hole they're in that was caused by COVID. I have one master plan community that they're limited to assessment increases of 5% every year. We've projected for them that it will take 10 to 15 years for them to get out of the hole they're in and to have enough money to operate operationally and to also have enough money to fund reserves, because they've tried passing special assessments and they will not pass. Their community requires a 75% special assessment and they cannot get it passed, an approval of the membership. I would caution you as well that communities that do not maintain the common areas, it has a direct effect on the value of the units within that association. And so if you're an association that has deferred maintenance or you're not setting enough money aside for major repairs and replacements, beware. That does affect, quite frankly, the value of most homeowners' largest asset, which is their home. We've seen a lot of homes that the purchase and resale value is going down in those communities where they simply don't have enough money to pay their bills and they're not maintaining the common areas. People are not going to pay a premium for a home when it's in a community that is not being well maintained. They're actually going to pay a discount. So keep that in mind as you're budgeting for 2026. And again, I'll end, but keeping your nose clean from a financial perspective and a tax perspective, it's really not rocket science. It's pretty easy. Be sure you send out a budget, right? Be sure that you complete or have Cadden complete your Arizona Corporation Commission filing. Make sure your tax returns are completed. Even though you're a not-for-profit, you do have to submit a tax return. The taxing authorities want to hear from you. And finally, be sure that you have your compilation review or audit performed every year. That is state law, okay? I would encourage you to engage a firm that's familiar with the industry. Just like any industry, whether you're having roofing performed or landscaping, you want to hire a competent professional that's familiar with the industry and knows what they're doing. Finally, I'd be remiss if I didn't thank Jeff and the whole team, Brett, the whole team at Cadden for inviting me to speak with you tonight to share some thoughts. I love this industry. I love providing education and training. And so I really do appreciate the opportunity to spend a little bit of time with some of your members of your boards tonight, Jeff. And if there's any other questions, I'm willing to take those now. Or if anybody has any questions for me, feel free to email me as well. If the question's not too tough, it's not going to take me too much time to answer. I'm more than happy to answer any questions that I receive. And again, my email's phansen, Hansen, at butlerhansen.com. Not trying to market you, I promise. I'm trying to make myself available to you. If you have any questions that aren't too difficult to answer, meaning it's not going to take too much of my time, I won't charge you. Be more than happy to answer any questions free of charge. We do have a question that came in. What's the cost of a reserve study? That's interesting. I don't see those costs really. But if I were just shooting from the hip, Jeff might have a better feel for it than me. I'd say for your average community, a cost of reserve study is going to be anywhere from $1,000 to $2,000. Jeff, what are your thoughts on that? Do you have a better feel for that than me?
Yeah, I mean, it's really going to depend on the size of the community, the assets you have, what they're going to be evaluating. I would say probably in that $2,000 range. Thankfully, once you do your first research study, your every 3 years or so revisions are less costly because they already have the data. They've done the inventory of your association. So to revise the numbers and your 30-year projections, it costs a little bit less for that.
Yeah, because they're just basically putting all they're doing is these reserve study companies, just so you all know, all they're doing is they're feeding your information into databases and software that they have, and having that information updated by the updated tables again, right? So once that initial study's done, like Jeff said, it's pretty easy to update it. They're just crunching the numbers. Anyway, we had a couple more questions. One said, "Hey, Paul, your presentation was right on. Great summary of the important things. I appreciate that. Thank you." And I think there might have been another question as well, but I'm not sure, Jeff.
Yep. So does the budget need to be sent to the community members via mail, or can it be posted online, like on their community portal?
Okay, so that's more of a legal and document specific question. I would tell you to always check your documents. Some documents require budgets to be sent to your community members. Some it can just be sent to the homeowners. It varies. So check your documents. Jeff, correct me if I'm wrong, but my understanding is state statute does not address how the membership receives the budget. Is that accurate?
Yeah, so same thing. Check your documents, especially if you're going to be changing your assessment rate. There's usually some notice requirements there if you're going to be increasing. Commonly, it's you have to give at least 30 days notice if you're going to increase the assessment rate. So keep that in mind as well.
Yeah, and again, some of these things are key for you as boards to understand. Like if I were to ask anybody on the call tonight, I wonder if you know this. Does state law require a single-family home community to even create a budget? Does state law require it? And if you're on the board of one of those communities, I hope you'd be able to answer that question. And your answer should be no. State law does not require a single-family home community to create a budget. There's no statutory requirement in Arizona. However, your documents may require it, and certainly it is absolutely best practice. Conversely, does state law in a condominium community require an annual budget? Absolutely. It doesn't care what your documents state. State law requires it. You better dang well I'm getting a little bit vocal here. If you're a condominium association, you have got to create a budget. You don't have a choice. State law dictates that, actually. As far as distribution to your members, again, that's more document specific. But you do need to understand some of these concepts in state statute. Really a good question.
Yeah. Another question came in here. Do monthly financial reports need to be distributed to the members?
Monthly financial reports?
Monthly financial reports.
There's absolutely nothing in state law. I'm not an attorney, but I know there's nothing in state law that requires it. I've never seen any documents that require it. So I don't think they have to be, not from what I've seen. However, it is best practice for management companies to distribute those reports to the boards and or finance committees, because it's the board and finance committees, if one exists, it is their responsibility to monitor what is going on financially and operationally. And it is impossible for a board of directors or a management team to monitor what's going on at your community if they don't receive some of the basic, and I mean basic financial reports as far as a balance sheet, income statement, copies of bank statements, copies of bank reconciliations, accounts receivable agings, prepaid agings. These are all basic reports that boards should be receiving. And if they're not, quite frankly, that's a fraud indicator. Whenever I've seen fraud or malfeasance in my 25 years, and I've seen a lot, there's always some common themes. And one of those common themes is when a management company does not provide relevant financial information and timely information. Usually means they're hiding something. There's something they don't want you to see. And so I'm going to put Jeff on the spot right here and say, Jeff, with Cadden, and I already know the answer, but with Cadden, what do your monthly financial statements packet? What does it look like? What are some reports that it typically contains?
Yeah, we usually get the complaint the other way that we're providing too much. The items that you stated, your balance sheet, your income statement, your budget comparison report, general ledger detail, bank statements, reconciliations, like you said, accounts receivable, you have your payable aging, your check register. And
so you're providing, sorry to interrupt. So you're providing a very, very transparent monthly financial packet. So your board of directors, if they want, they can spend 3 minutes perusing it, scanning it, or they could spend 3 hours just delving into every transaction, right? Yeah.
And what's nice is we typically send that full packet to our board members, and then once they're approved, we send a condensed version out and make that available to the homeowners.
And that is industry best practice. If Jeff wasn't on the call, I'd tell you all this as well. I think Cadden's, what they're presenting to you as a board, quite frankly, is very, very good. It's well within, if not exceeds, industry best practice. So, again, if Jeff wasn't on the call, I'm a straight shooter. I'm a Boy Scout, as Jeff probably knows. I would absolutely share the same thoughts with you. I think that what you're receiving from Cadden, from what I have seen, actually is a very, very high quality financial packet to allow you as members of the community or your board to monitor what in the world they're doing to make sure they're doing it right. That's your job. So some more questions I think have come in, Jeff.
All right. So one comment here was that they send their budget out to the homeowners with their annual dues letter, which is great. I
Yeah.
know some of our communities, their annual meetings, line up really with budget season too. So you can kind of save some cost by sending your budget out with your annual meeting documents too.
Yeah. Yeah.
So where could we find additional education materials on this subject?
That is so difficult. Wow, really a good question. Unfortunately, there's really not any resources, if I'm being honest. And the reason is because it's just simply not a sexy area. Let's be honest. We hardly have any board members that even want to join this call tonight, or any trainings that I give. People just aren't interested. And so as you look at the tax laws related to community associations, there's almost nobody that knows anything about it. Why? Because it's such a specialized area of taxation. Nobody cares. Nobody cares. And so there's not a lot of professionals that even understand HOA tax law. That can be very complex, to be honest. As it relates to some of the, now, I don't want to be, totally negative. The fact is your resources are extraordinarily limited. However, if you're a board member, I would encourage you to join the Community Associations Institute, or CAI. I believe CAI has the best education information for boards nationally and internationally. It's actually an international organization. It is the most well-known and most well-respected national and international organization in this industry. It really is. And so you can go to the Community Association Institute website, and you can they do have board trainings. They have all kinds of trainings. And so that is about the only resource you have, to my knowledge. And I'll repeat, it's the Community Associations Institute. There's an Arizona chapter as well as a national chapter, national website. I would check both of those websites for educational resources and classes.
Yeah, that's a great suggestion. I know when we first joined that, I would always refer to it as the CIA. I joined the CIA. So
Yeah.
no, it was the CAI.
Yeah. Yep. Yeah, really a good question.
No, I would just like to point out another item here. I know we talked about community-specific requirements, and I just want to point out too that the state law does require that you use one of those 3 financial reports, at year end. But your documents may also require you use one of those in particular. I know we've had a handful that say, you have to have an audit every year, or maybe every 3 years. So just be aware of those requirements in your specific documents as well. When you're making
good point, Jeff. Because if your documents require an audit, you can't have a review or compilation. The way the state law is written is if you can choose every year if you want to have an audit, review, or compilation. However, if your documents call out a specific level of a report from a CPA, you do have to have that performed. You can't have a different service level performed. I saw another question that came through. Now I can't remember what it's regarding because I'm getting to be old. What was that question? I saw it and I'm like, oh, I got to address it. Now it's gone.
Let's see here. Does CAI cost money to join?
Good question. I am honestly not sure. Certainly for business partners like my firm, it does. For board members, I think it does cost, but I think the fee is very, very nominal. In fact, if you're on the board, I think it would be very easy to talk your board into joining or allowing you to join and having the association pay for it so that you can get some additional education and training. And certainly that would not be an expense or cost that, in my opinion, would be outlandish or inappropriate.
Yeah, great questions.
Yeah. Anything else related to taxes, budgeting, audits, reviews, anything like that, inflation? Okay.
That's all I see so far in the chat, but Paul, I think it's great. I mean, your points are well received, and I would echo a lot of those. Especially, when I do our board trainings, I always try to say, don't be afraid to be the board that increases the assessments, or don't be afraid to be the board that spends the money that's been saved to maintain your assets. That's your job. So take that fiduciary responsibility, to heart. And protect the assets of your community and your fellow homeowners.
Yeah, I'll add this, Jeff, and I'll be quiet. I apologize. But yeah, I mean, as you consider this, those that are on the training or the call tonight, keep in mind your members are. It's a lot easier to accept a 3 or 4% assessment increase every year than it is to go a couple of years without assessment increase, and then you're nailing them for 10, 15, 20% assessment increases. That's painful for anyone. But it's a lot more palatable to just say, you know what, every year we're going to have a 3 or 4% assessment increase because, inflation's there. It never goes away. It's never going to. So that's a lot more palatable to the membership than waiting a few years and have these, special assessments or these ridiculous, 20% assessment increases.
Yeah.
Yep. All right.
Well, so some thank yous here in the chat, and I will echo that, Paul. I thank you for spending time to you and your firm for sharing your industry expertise. And again, if anyone has follow-up questions, please feel free to reach out to either one of us, and we will get back to you. Thank you so much for spending the evening with us.